Good morning. I would like to welcome my listeners and viewers in the United States and all around the world. I am Vince Rocco, and it is Tuesday morning in New York City, so let's go behind the headlines and get the real story. But first, this is Talking New York Real Estate. And up front today, buyer reluctance in the New York City luxury market often stems from various factors tangled with the city's unique dynamics. Uncertainty, particularly in economic conditions, can breed caution among prospective buyers. Additionally, the steep prices characteristic of luxury properties in prime New York City locations can deter even affluent buyers, especially when weighed against perceived value or potential returns on investment. Heightened market volatility fueled by global economic shift or geopolitical tensions further intensifies apprehension. Evolving lifestyle preferences influenced by factors like remote work trends or shifting demographics contribute to a hesitancy to commit a high-value real estate purchase. And these complexities often cause buyers to adapt a wait-and-see approach as they scrutinize market movements and reassess their priorities before making substantial investments in the city's luxury property landscape. We're going to discuss all that, and we will have so much more as Talking New York Real Estate gets underway on this Tuesday morning. And in the news this morning, when it comes to broker fee behavior in New York City, the majority of sellers appear to be continuing to offer a full 3% commission to buyers' brokers. This, according to recent experts. Commissions for brokers who are members of the Real Estate Board of New York were officially decoupled as per new rules that went into effect January 1st. Instead of a seller paying a 5 or 6% fee that would then split between the sellers and buyers' brokers, a seller now will agree to one fee for their broker and a separate fee for the buyer's broker. The move coincided with major antitrust cases involving the National Association of Realtors, shaking up conditions around the U.S. recently, but was not an outcome of these cases, although Rebney was party to a separate broker fee lawsuit. Rebney is the dominant real estate trade group in New York City, and most brokers here are not members of the National Association of Realtors or the MLS systems that they use. And after 2 years of inaction, state lawmakers have agreed to a legislative package that addresses New York's housing crisis. Approved last week, the $237 billion state budget includes several new policies aimed at addressing the statewide housing shortage, including a new tax incentive for developers. The deal also contains tenant protections, including a version of good clause eviction proposal. And the new tax break, called 485X, is a 10-year program that succeeds the 421A program, which expired in 2022 and gave developers a tax exemption in exchange for including some affordable housing at residential buildings here in town. The new program provides a 40-year exemption, up from 35 years from the 421A. And celebrity developer Joe Farrell has relisted his 5-bedroom Park Avenue pied-à-terre for $5.99 million. With clients such as Madonna, Justin Bieber, and Jay-Z and Beyonce, Farrell knows a thing or two about high-end luxury. The 3,000 square foot gut-renovated apartment at Tony 510 Park Avenue comes with custom finishes like floor-to-ceiling steel doors with laminated glass. Farrell says, "It's on the market because I rarely spend time in the city these days, spending most of my time out in the Hamptons and in Florida, where my company, Farrell Building Company, also has offices. The unit has 5 bedrooms and a semi-private elevator landing. It is anchored by a 48-foot-long sunlit corner living room and dining room with oversized windows." And Farrell bought the residence for $3.56 million in 2013. Built in 1925 and converted to co-ops in 1946, the building sits between East 60th and East 61st Street. And with me today are Louise Phillips Forbes from Brown Harris Stevens, Jared Anton from Ellegren Forbes Global Properties, and Cale Goodman from Market Proof.
This beautiful set here at Studio 1873 is brought to you by the Everset. The Everset provides full-service staging and furniture rental solutions in the New York area. For more information, please visit us at staging.theeverset.com or email us at staging@theeverset.com to request a free proposal.
Okay, everybody. So we are here with local New York City experts in the luxury marketplace, in the real estate marketplace in general. But we're going to talk today about luxury, as I talked about in the introduction. And Cale, I want to start with you.
Sure.
You said recently in one of your LinkedIn posts I was reading, in the years since COVID, so many things stood out in the way of new inventory. There was the supply chain issues, COVID shutdowns, a perception of oversupply, and a high cost of capital. I mean,
Yeah, all those things.
we know all of those things. There was also an attention shift temporarily from New York to Miami.
I'm not sure how temporary, but yeah.
Well, I was going to say, I'm not so sure
Yeah.
how temporary. I'm not sure that I agree with it, but
Yeah.
it was. So how has all of this ultimately affected, the luxury markets in New York overall and in general?
Well, I mean,
Because I think your assessment is right on the money.
yeah. Well, the first thing we have to talk about is supply, right? Of which
Right.
the supply is very, very light, and there's very little coming to market. And then the second thing we have to talk about is the rates. So with the elevated rates, that decreases affordability, and then with the lack of supply, that increases price. So when you combine those two things, they're kind of opposite trends, right? The lack of supply raises prices, but the higher mortgage rates lowers prices. And so when you add those two things together, what you actually get is less inventory and higher prices. And because of that,
that's
right?
a direct cause and effect.
It's pretty clear, and that's not only a New York thing, right? That's something
It's
that's
across
happening
the nation.
everywhere. And just to kind of throw this, this Florida and Miami thing in there, which I think is important, is that, there was a moment at the end of COVID that we did not get, right? There was a catalyst, things could have happened. Unfortunately, things didn't go in the direction of New York when that happened. It really went in the direction of Miami, and Miami really got the attention out of that. If we kind of compare it to the kind of the 9/11 moment, that really catalyzed New York in a tremendous way for a lot of years, right? And we really benefited from that for a long time.
I wanted to ask you about the compare and contrast with the differences between coming out of 9/11 and then coming out of COVID. Vastly different, right?
But
yet,
catalyzing moments.
right,
Yeah.
right. But definite moments where buyers, sellers, renters, whatever, New Yorkers needed to kind of sit back and assess, like, okay, where are we and where are we going after these two?
Right, so I'm kind of bringing up different things at the same time for a reason.
Yeah, no.
And that is because there isn't a coherent story right now. And that, to me, is really the kind of fundamental piece of this. You have higher rates, you got low inventory, you got these catalyzing moments, you have demographic shifts, you got work from home. You have so many different things going on that for us, or any of us, or for home buyers and sellers to kind of make sense out of it is really a challenging thing right now. It's not
But
clear.
what's right for one person is not always right for another, and it's also what I'm finding in my own particular market is only so long people will wait to put their roots down. If your mentality is to be an owner, not
Absolutely.
a renter, so that's a shift that I'm personally experiencing with my business.
Yeah, so look, people still need to buy, they still need to go somewhere, but the coherence of the market is very up and down. And I think kind of what you're referring to originally was a story that was done in the Wall Street Journal about like what's happening in the luxury market right now. And that was a really long story. Everybody was in it. Everyone kind of put their 2 cents into it. But if you read through that now, a few weeks later, what you'll see there's a lot of different kind of disparate pieces, but there isn't a theme. It's all over the place. I think that's what Louise is saying here. Is like people still need to transact.
Exactly.
But how do we roll all that up?
But
into a
how do
theme
you
right
do
now?
that? But I found that article intriguing because coming out of COVID, for example, I mean, we were slow coming out of it, but then all of a sudden, by mid 21, it's like the market just boomed
We
and
did
exploded.
2 years of business in 1 year.
Exactly.
Yeah.
Yeah, once the
Everybody
vaccine.
killed the numbers at the end of that year. Interest rates was still very low, okay?
Yes.
And so people were out there buying, as Louise said, you can only keep New Yorkers down for a little bit of time because they
Yeah.
ain't going to stay in that chair very long. We all know that, right? And so we saw that boom, and then what happened?
Well,
Whether it's luxury or not, the rates started going up.
And, yeah, I say this all the time. The thing about the New York market, which is unlike most other places, is that we are a city of renters. So
Correct.
66% are people that are rental product.
And that's a big
So
number,
there's-
and people don't realize that.
So there's only so much that can be bought.
Okay, so thank you for giving me that because there are. I'll just
I'm a numbers girl.
let me give you some numbers around that.
Numbers girl, numbers guy,
So
perfect seating.
There's roughly 3.3 million owned residences in New York
Right.
City. 3.3 million residences.
Right.
Of those, around 1.1 million are owned.
Right.
So that means they can be bought or sold.
Yeah.
Of those, many are co-ops.
Yeah.
Many are co-ops, especially in Manhattan.
Probably 65%,
Yes,
64%.
and they represent roughly half the sales in any given time. And so New York is ultimately a very stable real estate market. And so that, that is something that is super important to remember, is that
it's a buy and hold.
it's a buy and hold.
And,
right.
and if you're making a transaction, even if it's a hardship, those opportunities are there because it's such a cash-heavy place.
Yeah.
And it's important to look at who's coming to New York, right? So New York, based upon the definition or based upon the fact about being, 3/4 or 2/3, I should say, renters, right, is incredibly transient. So you look at the news during those early days of COVID when New York was a ghost town, it wasn't that people were panic selling. It was that all the renters whose leases were expiring left and didn't renew.
Right.
Which is also why I have a conversion at 79th and West End Avenue, 393, where we were originally going to be doing about 38% of that building. We're doing over 75% because those tenants left.
That's amazing. And so now you look at who's buying in New York, right? So in those early days of COVID, when there was that boom with low rates, you had a lot of first-time home buyers that were taking advantage of now being able to purchase in a city that they love and want to call home in a less competitive environment because they weren't competing with cash purchasers, right? In the last couple of years, you've seen way more of that discretionary purchase, the luxury consumer come back because New York is now New York again. In the first years of COVID, you could enjoy, what made New York, New York.
Totally. And I also think that we're going to start to see in these pressured areas globally that, investors are going to start to come here. I've already experienced from the Ukraine, from Israel, where they're bringing back, money here for themselves personally, for their children's future.
Absolutely. And
Go ahead.
What's important to know, too, is there was an article a couple weeks ago talking about how if you look at the 5 quadrants of the U.S., the Northeast, which has been the most hit for much of the COVID period in terms of price and price appreciation, has benefited the most in the last quarter as that return to work, as the fact that the second or tertiary cities have run their course and, the beach life, has run its course as well. And companies are starting to recall employees, at least on a more structured way. The Northeast is going to benefit from that, and New York in particular as well.
For sure.
So, good point. But so, the title of our program today is the confusing luxury market.
Yeah.
So, I get all of this, but when people out there are looking at our markets here in New York City, luxury, okay, the greatest word in the world, luxury in New York City, they deem it confusing.
Yeah.
They look at it as confusing. Why is it confusing? What does that really mean? And how do we get out of that confused state and get back on a level playing field?
Well, it sounds like you should run for office here.
But if I were 40, I would. Trust me. Believe me.
Look, I mean, we have a lack of inventory, and we have a lack of pipeline coming, and so people who are looking for luxury product don't have a lot to pick and choose between.
For sure. It's also caused an elongating acquisition period.
It slows down, right? It slows the process. And so given that, it's just, as I was saying, it's just very, very choppy. I mean, right now in Manhattan, maybe you remember the numbers off the top of your head better than I do. We have something like 3 years of supply at current absorption rates.
And 2 years ago, we were at about 10 years worth of inventory.
Right. Yeah, so it is really...
We're talking inventory in general or new development?
I'm talking about shadow new development inventory.
And you also have to realize there's another thing that the unintentional consequences of changing the rent laws in 2019.
Well, yeah.
You were absent
now
of
we're really
all...
getting into the politics.
About to start that up again.
Yeah, but just to be clear, you are now... don't have co-op and condo conversions from rental buildings.
Right, even less, right.
So that is probably, we figured we're now in our 5th year, 19 to 20, so June will be 5 years, and that's around 2,000 to 2,800 units annually. It's a lot of housing for ownership.
I mean, in our numbers right now in New York City, I don't have the Manhattan number off the top of my head, there's just less than 10,000 new development units available for sale.
Yeah, that's amazing.
It's real. I mean, look at the size of the city, right? If you got and in Manhattan, here's a number that's popped into my head. The housing inventory grows at less than 0.5% per year.
Wow. That is a
Go to Phoenix, right? Look at whole new neighborhoods, right? It's a tiny, there's just nowhere to go. And so when you close off these other avenues for growth, conversions,
Yeah.
et cetera,
it's going to be an issue.
it's just going to be super tight. So the luxury buyer has just very little to pick and choose between. Now that doesn't mean, and this is where kind of some of the choppiness comes in, there aren't great units to buy.
Right.
So we continue to see
Right.
very large transactions, very large, and a decent number of them, but it doesn't translate into kind of overall volume.
No, it doesn't. And as we talked about offline a little bit, it kind of skews the numbers, right? Because all of these larger deals are put into the same bucket as every other deal, and so everybody says, "Oh, look at the revenue numbers, or look at the deal volume, or look at this, or look at that," and actually, it's a little skewed. But we have to take a break, and we'll come back. I want to though talk about defining the luxury market. What is that number? Because viewers and listeners of mine for a very long time, I get texts and emails and whatever after each show.
What are the break points?
What are the break points? What are the numbers, Vince? I mean, is it 4 million? Is it 10 million? What is that number?
Well, ultra luxury would be 10.
We'll talk about it after the break. We got to take a break. We're coming right back. Don't go anywhere.
What do you really need to know about buying or selling a home? First, it's serious business, and it's complicated. There's a lot of money on the table, and emotion too. You need an agent who knows the ropes. So, whether you're buying or selling your home, work with professionals who have a mastery of the craft.
Okay, we're back. So we're talking about what number actually defines the luxury market. Okay, we have all kinds of price points here, from 500, if we even have $500,000 apartments anymore, up to tens of millions of dollars. Okay, what I call the meat and potatoes these days has probably come from 2 million and under. Where it used to be, in the high hundreds. I'd say 2 million and under meat and potatoes, which is probably what most of the market is. But Cal, what, people, as I said before the break, people ask me all the time what those numbers are, what those break points are. What are they?
Yeah, so Jared and I were just talking during the break, and I mean, generally we look at it as like the top 10% of the market is considered luxury. So
top 10%.
Top 10%.
Okay.
So there's going to be a wide range of numbers based on where we're talking about. In Brooklyn, it's going to be a little lower. Let's call it 2.5 to 3 million. In Manhattan, it's typically considered to be 4 million. Right, Donna Allshan report has always been kind of the standard bearer
4
for that.
million and
4
above.
million and above.
Right.
But then there's really also the ultra luxury now, which to me should be thought of as a separate category.
Should be separated from that.
And that's
for sure.
really 10 million plus.
Okay.
And that's what
I wanted to get at. Go ahead.
And that sector of the market is really independent of any particular city. Right? These are people who are operating on a more global scale.
And it's easy when you look at it on a price per square foot basis, right? That removes a lot of the noise of the aggregate price. So you have, 3 different levels of luxury. You have your affordable luxury, which is 2,000 to 2,300 foot. You have your luxury, which is 3,000 to 4,000. And then as we talked about, you have your super or ultra luxury that's 5,000 plus a foot. You have those 3 sort of tranches. And then luxury is more than a number. It's the look, it's the feel, but it's really the experience.
For
You can have a really luxurious, small and lesser expensive property, and you can have some very large, properties that don't feel super
it's that
luxury.
Show place.
Exactly.
Not necessarily grand in size or grand in price point, but it's that show place that maybe stands out among other places.
I mean, you can look at the West Village and you look at some of those spots on you cannot be very luxurious and be in a price per square foot high luxury point based on location.
And then you have your trophy properties, which is the creme de la creme. And if you look at, in 2023, out of the top 15 sales by price in the city, 8 of them were on or around Billionaires Row, because there's only so many locations in the city that you actually build that ultra luxury inventory in that 57th Street corridor, that Central Park South, that Central Park West, and a little bit down into the West Village where you really have those properties. But that still remains the center point for the international, investor or the person that wants to be able to purchase here that's not an ultimate primary user. And truthfully, at that price point, the people that are purchasing, this is a second, third, fourth, fifth, 7th, 10th home for them, right?
Yeah.
So there's a difference between what a local consumer who wants to buy a quote-unquote luxury apartment may purchase, and then there's a way more myriad of options across Upper East, Upper West Side, downtown Brooklyn, things like that.
What I think also contributes to the the thought of or the thinking of luxury markets being confusing are the different neighborhoods where all of these properties reside, okay? So, there's still the stigma of outside of Manhattan may not be so luxury, Brooklyn or Queens or here or there. However, they are. And as you guys were talking about in the break, Brooklyn has luxury and high end. What did you say that percentage was again, Jared? Based on, 2% of...
In terms of the price per square foot, or the top 10% in terms of the price? Yeah.
Top 10%.
So, right, luxury market is commonly defined as the top 10% by sales price.
Right. Okay. So there are luxury, apartments all over the place. So when you look at these different neighborhoods and buyers are out there asking you to, take them to these luxury places, do they separate neighborhoods, Louise, or do they just kind of say, I want this type of apartment, or I don't want that type. I want a show place. I want a big place. I want an expensive place. Whatever.
My experience with defining, there are so many boundaries that used to occur in neighborhoods that have blurred. Like what people try to call Hudson Yards in the West 30s, and
well, they're trying to make all of the West 30s Hudson Yards.
Yeah,
I did a development there, very successfully sold. I wouldn't call it Hudson Yards.
True.
Okay.
However, I think that there are entry levels that I definitely utilize neighborhoods for educating. Meaning, if you want to be in the West Village, you want to be at Mecca, then these are your limited choices. And sometimes, like from an inventory standpoint, you may only be able to look at 6 or 7 choices, and not often do you make decisions that quickly.
And I look at luxury and speaking with our consumers as that lifestyle, right? So Brooklyn is going to have a very different feel for their luxury market. It's going to be much more in the aesthetics and the finishes that are going to look and feel incredibly different than, Billionaires Row. There was an article yesterday in The Real Deal about a new Naftali project that just got announced right on the waterfront in Williamsburg. And this is going to be a super luxurious project that's aimed at owners and basically saying, look, this is an alternative to having a Hamptons escape or, going up to the coastal Connecticut or areas like that, because the project is going to get billed as like a beach club type thing. So that's a different type of luxury that's speaking to a different type of consumer, but it's equally as luxurious, just for different reasons. And this is why what is luxury is so confusing, because the city is a land of so many different types of product. It's not like we're talking about Palm Beach, where luxury means you have, a house that's 75 or 8,000 square feet, and you're within spitting distance of the ocean or the Intracoastal, right? There's a more clearly defined,
diversity in what that luxury can appeal to different people, which also gives birth to very diverse communities, which is also very interesting to me.
Exactly.
Kale, what are the trends that you're seeing in the luxury market space, whether it's new development, sales or just resales, because some of these co-ops are absolutely fantastic from a luxury perspective, but are there any trends that are emerging lately that have not been around, say before COVID or right after COVID? Is there anything new that the luxury buyer out there is looking for based on what you see in the numbers or not, or what you hear from other people?
Yeah, there's been just a gradual move towards higher prices per foot, and that's been going on since really Walker Tower and
Stella Tower.
Yeah.
It's just been a very gradual process for the last 15 years or so, and it's continuing.
Maybe a little bit longer.
And developers are pushing the envelope as they build nicer, as they build higher. They're constantly raising the bar of what's
Especially
available.
Since during Bloomberg's tenure, he rezoned 40% of the landmass of Manhattan.
To allow that higher density and taller
Billionaire
buildings.
Row.
So the gap that we see between that new product and the existing product gets bigger and bigger. It's just
Yeah.
a very gradual spreading
And
in
that's
the prices.
Because
that's one of the
people- go ahead.
Sorry, that's one of the key reasons that you're seeing the spread between condo and co-op prices widen.
Yeah.
You know, back in the
sure.
late
Big
90s,
time.
it was a 10% delta because condos would always have a little bit more of a premium for the flexibility and because the carrying costs, you know, all else equal was a little bit lower. But that has widened to 30%, 35% because of
Yep,
the
for sure.
amount of more luxurious things just skewing that price. It did narrow a little bit in COVID when co-ops had their day with local consumers, but it's spreading back again.
Yeah.
Jared brings up an important point. If I could just build.
Yeah,
on for
yeah,
a
go
second.
ahead.
So the spread between the new development product and kind of the resale condo product has gotten to like 30-35%. And then the spread between resale condos and resale co-ops is another, I think, 20 or 25%, something like that.
Yeah, that's-
so we
that's-
really have this kind of three-tiered
Three tiers.
market in Manhattan.
And I'm going to quote Jason Thomas. Jason always talks about the different vintages of new development, right? The vintage 1, which is, you know, the new, the vintage 2 was what was the middle of last decade, and the vintage 3 was the pre-2008 sort of build. And every vintage got more and more luxurious. It got larger apartments, and you changed from building a lot of studios 1s and 2s, where the only way to get a large apartment was to
Yep.
combine, to now
Oh,
building
yes.
substantially larger
remember those
properties.
days.
Yes.
And it's because the developers they can charge more for more contiguous square footage, and it's the only way that they're going to be able to make the buildings more economical because the cost to acquire the development site is
Are
off the charts.
So much
ridiculous.
more.
The cost of the land, the
Right.
cost of the build, the price
And
per
the
square
time
foot
to build.
Correct.
and the time to build.
The cost of carry.
But people always ask me how we evaluate the
Yeah.
value of these properties. You said, you know, prices have gone up, price per square foot on the new
Right.
development side over, you know, existing inventory. And people say to me, well, you know, how do you guys evaluate that price? How do you come out with, you know, $3,000 a foot versus $2,000 a foot? I mean, we all sort of know the answer to that, but
Yeah.
for our listening audience, how is the evaluation done on these properties? Again, whether it's new development or resale.
Look, for the resales, there's metrics that are easy to find and use, especially for condos.
Well, yeah.
For the new stuff, it's aspirational pricing.
It's a
right?
crapshoot. It's
Yeah.
whatever
Yeah.
pleases
Well-
the lender.
Yeah.
Well,
Well, sir.
well, thank you. That's what I was going to get at. It's aspirational pricing, and the banker says, "Hey, you know," and then the buyer comes in and says, "Well, you know, you're asking $2,700 a square foot. I can go down the street, and I've had this personally happen to me. I've done a
Yeah.
ton of new development in my career. Well, I can get something for, you know, $2,100 a foot or $2,000 a foot. Where or why is there a delta or a difference?
Let me give
Cost
you
of build, cost
yeah.
of land. It's really what the developer.
Architect.
Starchitect, there you go. It depends on everything, I say.
Let me give you a slightly different way to think about it. I was working with a client recently who was looking at buying a property for $29 million cash. He said, "All right, what's my downside here? Right?
Yeah.
What's my upside here? Your upside is basically zero.
Right.
say.
And your downside's 29 million.
Yeah, exactly. I mean,
And
it is what it is, right?
And it's a one-of-a-kind unit.
Yeah.
It has a huge outdoor space. You're going to be entertaining there. This is where you're going to do business. Your economic downside is maybe 10% over a handful of years, but the opportunity that you're creating for yourself, that's for you to evaluate. Do you have the money? Can you afford $29 million to buy this thing? If yes, then buy it and love it because it's got to be awesome.
So did he buy it?
I can't say,
Okay.
In
but
the
that was the
process,
analysis.
And that's the intrinsic and extrinsic, right? It's
Yeah.
and at this
Yeah.
sort of luxury price point, it's what is it going to do for me? It's not so much an economical or an investment
It's not a
decision.
need buy.
Well,
You know.
I was going to follow with, you
Right.
know, 29 million. I
Right.
mean, you know, most people from where I come from would
Right.
say, you know, for $29 million, I'll buy an island somewhere.
Right.
And a boat and float around for the rest of my life.
Right.
What are you buying in an apartment for $29 million?
Well-
yeah, it's luxury. Yeah, it might
The
be a show place.
experience.
Yeah, it's the experience. Right. But
This
but
is a-
again, if you have it, it doesn't
can you
matter.
afford it?
Right.
Are you going to do business there? Are you going to enjoy it? Is this something you want? Mm-hmm. That's really what it comes down to.
I don't know
in
if
the
it's
end.
something they want. I think sometimes it's like they can afford it, they want it because they want it, just because they want it, but they don't really, you know, what's the need, you know? First of all, most people buying it, I'll sell it. Okay,
Yeah.
I'm not complaining.
Yeah.
I'll sell it.
Yeah.
But the bottom line is, most people who buy those types of units, apartments rather, they have houses all over the place.
Of
I mean,
course,
it's one more added to the book, so to speak.
Yeah.
But evaluating, prices and evaluating or comparing rather one development over another development over this building with this penthouse over that building, people legitimately say,
All right.
hey, where do you come up with the right number for that property?
All right, so that's a slightly different thing.
That was just going to say.
Yeah.
So, did you counsel him to make an offer lower than the asking price?
No, that was not available.
Okay.
Right, that was the price. If he wanted it, he needed to pay.
Right.
It's a one of a kind piece.
That's right. Sometimes it is what it is.
And if he didn't want it, somebody else in time would step up and buy it. But your point here is maybe a little different, which is that when you step back and you look at the market as a whole, all of the developers, or most of the developers, have gotten pretty sophisticated at this point, right? They have an inventory of stuff, and they have some MBAs or smart people who can crunch these numbers, and they have two things they're thinking about: price and sales velocity, right? If you want to maintain your price, then your pace of sales is got to be a little slower. If you can afford
That's
to
right.
slow down and you want to keep that price
Time
up,
value of money.
then
That's
you
right.
keep the price up. If you want to move your inventory a little quicker, then you bring your prices down. And so at Market Proof, and what we help people do, get my own little plug in there for a second, we help people to see where these projects are in their life cycle. Early in the life cycle, they need to move units, right? So they're going to discount
Right before an important threshold, like going effective.
before effectiveness, before they reach certain milestones where lenders are more willing to lend. And then later, after they've reached those numbers, they've made a little money, they might raise
They
the
can-
prices.
yeah.
Right? This is where they reap the profits.
Oh, I've been on all
Right.
ends of that one. Yes,
Right.
of course.
And sometimes
Once
they take it
declare
out
the
of
plan
reach.
effective,
Yeah.
the prices go up, and then people are like, hey, and you know this too, hey, I better start getting on line for these units.
That's right.
In most cases.
That's right.
Because the prices are going to start going up. Listen, one of the developments I sold early on in my development career, we had 19 price improvements in like 7 months while we were selling the building. 19. Up.
Yeah.
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 And
Every time an apartment in the line sold, whoops,
Right,
the rest
next
of them in
one.
the line got raised.
Well, I think it's important to touch on, how the life cycle of a new development is different now than it was 10 years ago.
Oh, 100%.
10 years ago, you sold 18 to 24 months before the project was delivered.
Right.
And you sold entirely off floor plans. You had,
I
they
love those
sold
days.
those
Love,
10% quietly before they ever announced. So the plan was arguably declared effective before it ever became public.
Correct.
And yeah, you sold 3 units, they raised the price. It was traditional airline pricing, right? Today, it is such a
Pricing. Okay, yeah.
You're right.
Today, it's such a shorter sort of life cycle where people want to be able to look and
See and
feel,
touch and
the
feel.
uncertainty is higher now. So they're only
For
starting
sure.
sales 6 months, in some cases 3 months before delivery. So we're,
I just want to just add to that it's kind of interesting. I've done 35 development projects, and those off the floor plan kind of sales, the community of the buildings are very different than see it, touch it, feel it processes. I don't know if that really means anything other than it's just my observation, having done so many of them, and the communities, in my experience, it's more thoughtful and cohesive communities.
yeah.
Just cocktail trivia, I'm adding to that. And probably for myself, a little more fulfilling.
But it's interesting because, like, if you look at our, accounts receivable, we used to carry 30, 40, 50 units that were 18, 24 months out on our receivables. And now the new dev business that we're doing is closing quicker than a co-op sale, where it's 30 or 45 days, especially if they're cash, no board
Welcome
package.
to managing
That's gotta
agent.
feel. That's gotta feel good.
That feels really good. So
Well,
we're turning our receivables much quicker now.
Right. Well, it feels good because the units are available.
Right.
I mean, I agree with you. I started selling new development off of floor plans. I mean, that's all we had to do. And everybody went home for 18 months until the building was ready to deliver and close, right?
Jared-
I want my commission check. Yeah, you got to wait 18
well, Jared
months.
actually is.
Nope, you used to get half
We
of
used
it.
to get half salary, correct, yes.
Could I go off script here for a second,
Yeah, go
based
ahead.
on what Jared just said? Because not only is that time frame compressed, but also the commission rate is higher.
Yeah.
Yeah.
We did a study recently. So there's all this talk about commissions going down, right? What a buyer's agent's going to get. That does not apply in new development sales,
No.
in new development luxury sales.
Yep.
Here's some numbers. 40% of buyers' commissions in luxury new development in Manhattan are 3%.
3%. Okay.
40%, another 40% are 4%.
4%.
And then
That's
another
70% of your.
right, and then another 7% are greater than 4%.
And one nice 6%er.
What's that?
And one nice 6%er.
Can we say who
The,
that is?
the Waldorf.
6%, right?
Yeah.
So these are
Go ahead, finish.
So these are, they're big numbers. These are premium sales and big commissions. And what's remarkable also is that the pool of agents that are servicing these buyers is relatively small. So, we, at Mark Proof, where we look at these every day, and we publish something called the Daily 3, which looks at who's bringing the deals to the table. It's a round up the usual suspects. It's a
Right.
remarkably small group of people in Manhattan
But
that are doing these deals.
What's interesting, I'm going to stay off script for a minute, but it's really important to put a little plug in something. So with all the impending changes and the requirements to use the buyer-broker agreement, and the NAR put out some very clear clarification and guidance that
NAR.
whatever commission you put on that agreement, you can't take more than that. So this brings up an interesting question. If you are a buyer's agent, you're putting 3% on your buyer-broker agreement that a buyer is signing, and then you go to a new development that's offering 4 or 5, technically you can't take that additional 1 or 2 points, and we need to credit it back to the buyer. So there's going to be a very interesting thing, and this came up
That's an
on a
interesting-
NIRAC call that I was on last week,
That's interesting.
is how are we going to work around this? And are you going to have a different agreement if it's new dev or resale? Because it has opened up where new
You're
devs.
saying you represent the buyer. You have a buyer's
Yeah.
broker's agreement. It's at 3%.
You can't
The
take more.
You can't take the 4%.
But that's just going to have a clause that's going to say excluding.
Perhaps, yeah.
The development.
We'll figure out a
That's
way.
really interesting.
But yes, because new developments have been paying higher commissions to entice the buyers, in part because they're also charging higher prices. So it's an and both. But that has been looked at as a beacon for buyer brokers that have been concerned about commission compression on the buy
It's
side.
not like it's benefiting the buyers.
Right.
Just to be clear.
They're paying for it.
They're paying for
Correct.
it. So I'm not sure how I feel about that. I just had my first request for somebody wanting me to take on their business to sell. This is somebody I've done 4 or 5 transactions with, who's like, so with all this stuff, you want to handle my full floor at 1.5%. I'm not sure I'm going to pay a buyer's broker. And I'm just thinking to him,
Here we go. On that note, we're going to take a quick break. No one's
Come
going
back.
anywhere. We will be right back. Okay, we are back. Kale, I want to ask you, I'm reading your report here.
Please.
Okay. Tuesday
he
morning
gets
report.
notes.
Yeah.
May kicks. You say new developments. Okay, this is new developments. May kicks off on a positive note with demand outpacing April's weekly average. Okay, and you go on to say new development deal volume took an upward turn in the first week of May, improving from 52 contracts to 65. That's a 25% uptick week over week. What's happening, or what happened to the new development scene between the end of April into early May? 1 week in.
Yeah, well, I mean, we talk about the weekly numbers, and they do kind of go up and down.
They
a
go up
bit.
and down.
But I try to kind of overall blend it over a longer time period. So you have to look deeper into that report to see
Yeah.
what actually happened. I don't remember off the top of my head, but there must have been something that came on the market that reported a few deals, so that
Yeah, you have batch reporting on the new dev
Not only
side.
just new stuff comes in the market, and this spring there's been a bunch of new stuff.
A lot of scooping.
Not so much in Manhattan.
Brooklyn,
but
Queens.
Brooklyn, Queens. There's been more, but generally, if we kind of step back and look at it more broadly, we talked a little bit about the 2021 run-up and how that's kind of gone away. Generally speaking, what's happened right now is we're just back to where we were.
It was interesting at the end of 21 when I said, coming back from COVID, I happened to have been assigned a new building on West 37th Street, okay? I don't know, 14 units, I can't remember. All over $2 million, okay? Floor throughs, I mean, beautiful. Okay, the neighborhood was what I call Hudson Yards adjacent, okay? Nearby. But,
Halo effect.
But I have to tell you something, and the developer said to me, and I always have my love-hate relationship with developers, I'm not discounting anything. Don't come to me with concessions. Da, 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 da. The market is hot. I said, okay. I sold every one of those units in a matter of, so we opened in September. By January, they were all sold with the exception of one.
Okay.
Full price.
All right.
Full price. So we're talking 21 into 22. The only thing he conceded, because he had
Transfer.
no choice, is transfer tax. And I consider that a win-win.
Yeah.
Okay. I come from the day where when I sold new developments, the price was the price. You pay all the closing costs, Mr. Buyer. That is what it is. You don't
Yep.
like it, move on, because there are 5 other people in the waiting room waiting to come and buy it off a floor plan, by the way, as Jared said before. So, bottom line is we don't have that kind of movement in new development. And I wanted to ask Louise, because you are the guru in new developments, what is the story with new developments today? I mean, that activity, obviously, post-COVID, can't keep buyers in their chairs. We understand that. Price was right. I will admittedly say we were at $1,800 a square foot, which was kind of low.
That affordable luxury.
Yes, affordable luxury coming out of
On 37th Street.
On 37th
Just want to
Street.
preface that.
Correct. What's the deal with new developments these days? How fast and furious are you? I know you're doing very well on 93rd Street, but how fast and furious?
On 79th Street. So
79th
at
Street, excuse me.
393, we had, I am really data driven, and you'll appreciate this.
Yes, you
Dale.
are.
Sure.
And that I have always been this kind of developer's broker that will not talk out of both sides of my mouth. And I would rather find money as we are moving forward towards. So I underwrite very conservatively on acquisition, and then as we develop, and I'm masterful at floor plans, then you start to really understand who your target buyer is. And so we did very
all about
well.
floor plans.
We did very well. We created 6 different 3-bedrooms, ranging from 3.3 to 4.9. Those were originally going to be 3.8 to 5.4.
Wow.
And we held our ground and got 100% full price, 0 concessions in the first 17 transactions, and then interest rates took fire.
That's a whole.
So we now have done equally. I think we were running on 13 or 14, maybe 15 transactions since January, and that's buyers that saw our product a year and a half ago. Still have not made a decision, and they paid full price. But mind you, it was cheaper than it was 18 months ago. So I didn't really answer your question, except I did say that in that segment of the market, it's
right,
efficient.
It's all a segment. Every building, every block, every neighborhood, it's all a different
I
segment
find
of
it
the
a mini
very
market.
efficient. I
Yeah.
find it to be very efficient, and plus my carrying costs are $2.53 a foot, which is unusual.
That's very unusual. In my day when selling a lot of new development stuff, was always I want new because no one's ever lived there. I want to be the first one to live there. I love all the amenities that come with my purchase. Are amenities still, the driving force for people to buy new developments these days? Because, you buy in a resale building, you may have a little bit of a gym, you probably don't. You may have a rooftop, you probably don't, etc. Are amenities driving the luxury market today to the point where people are willing to spend whatever they need to spend on these
Absolutely.
units?
It has to be.
They are certainly a
Has to be.
draw, and they sell them, right? Because it's
That
about showing it
lifestyle.
off in the lifestyle. It's
It's
about
a
selling the
lifestyle.
dream. They're seldomly used, right? So they're incredibly
Well,
underused.
go ahead, I was gonna say that.
Which gives to a whole question about how they're maintained and how they're upkept once the board gets full control. But yeah, developers need to do it in order to create that appeal, that lifestyle, and really be able to set it apart, because it's very hard to compete on the actual product otherwise.
Yep.
People tell me all the time when they say, I have to have a gym, I have to have a garage, I have to have a pool. The best is, I have to have a pool. I never sold a new development, and I've done many of them that had a pool. And I would always say to people, well, why is that so important? Because I know what's going to happen. As Jared just said, very little use, if any. And I'd be walking around buildings, after we start closings. Anybody in the gyms?
Yeah.
No. Anybody on the roof terrace? No. But they say it's good for resale.
Right.
Yeah.
And it is, right? Because there's always that person who can't buy brand new for whatever reason, or didn't, snoozed and lost it. Come back, it's still newer, and it's got lots of amenities. Okay, I get it. Let's talk about geopolitical issues in our world today, and how the global markets or the global, issues that we're facing today, how that impacts not only the real, we know that it's kind of slowed down the real estate market in general based on interest rates, whatever, but from a geopolitical perspective, luxury market, right? People who have big money and lots of money to spend get spooked just like everybody else.
Confidence.
Yeah.
It's a confidence thing. So they get very spooked and they're like, whoa, I don't like what's happening on the other side of the world. I don't like what's happening in this country, whatever. How significant, though, is it really affecting our luxury markets?
Usually that's good for New York.
Usually.
Yes.
It's good and it's bad.
Historically.
Yeah.
Having just written our market reports, it's interesting. When you look at the end users, right, a consumer that's buying to use it, they're not discretionary, right? They're buying for need, and their biggest piece is interest rates, right? If you look at the luxury consumers, they're more likely that discretionary purchaser who needs to feel comfortable and upbeat and sound. The stock market, having dropped last month, it's recovered, knock on wood, most of what it dropped. The Iran-Israel standoff, the larger stuff that's going on in the world, and of course, the closer we get to the election, all creates momentary pause. It doesn't remove the demand,
No.
it just shifts it, right? So we did see this effect when you look at the April stats that you had a decrease in transaction volume compared to March. And interestingly, if you look at the COVID years, every April, most Aprils have been lower than Marches, which is counter to what it was in the last decade.
Because we're all writing a check to the government.
Right.
You think that's
I mean-
tax
And
related?
that
What do you
too.
think? that
It's in part, and last year it fell because we had the First Republic Silicon Valley Bank issues. So we
That
had a
was a
double
confidence
peak
issue.
last year. May rebound? Maybe, I hope. I definitely think as we get a little bit more certainty and we round out the election year, it's going to really pick up. But yeah, that discretionary consumer needs to feel comfortable. So if there's things that making them feel uncomfortable, it's going to slow down. To Cal's point, though, about why is it good for New York? New York is a top 5 investment destination. It's a blue chip investment. It's, quote unquote, catastrophe proof. And it is proven to be a store of value that also creates an incredible life cycle. So for someone that's looking to make the investment, we talked about people from Eastern Europe or parts of the Middle East looking to park money here. It's good because it is a safe place for them to
For
be,
sure.
and that bodes well. And that goes back to sometimes bad news is good news for our market.
There's the soundbite right there.
And that was the headline of my market report last week.
Bad news is good news for the market. Yes, I am not going to disagree with them. I agree.
For New York.
For New York, right. But I also have to think, though, that even here in New York, again, based on the price points that we're looking at higher than most other places, we're asking, the luxury buyer to spend more money than they would buying luxury somewhere else. So I'm just thinking maybe that gives them a little bit of pause when it comes
Maybe.
to...
Our luxury prices are not actually that high anymore.
Yeah.
And this is a really important thing.
Okay.
New York used to be, sorry,
No,
No,
go
go,
ahead.
go.
No, go.
New York used to be very expensive. I remember as a kid traveling and looking at the real estate, magazines while we're at the restaurant, and it felt so cheap.
So that's where it started, right?
It doesn't feel cheap anymore, right? New York, everywhere else doesn't feel so cheap anymore. So
Right.
our luxury is really not any cheaper than buying in Boulder. I was just in Boulder a month and a half ago. The price per square foot is equal to or greater than New York City right now on average.
Yeah.
The ski markets in Colorado, South Florida, Los Angeles. So New York is fundamentally not that expensive. Even when you look at the other top 5 destinations, London, Hong Kong, Monaco, New York is actually a fairly good, quote unquote, deal.
Quote unquote
Right.
deal. But what I was going to say.
And we all love deals.
Yeah.
Right?
I what I was going to say, which it just fell out of my brain. So we're going to move on.
Okay.
It'll come back.
Well, let me
Comment?
bring up, how much
Yeah.
time do we have left?
Go ahead. We got time.
So, and I'm going to go off script again if that's okay.
Perfect.
Because part of the, the whole issue with luxury and what is luxury and what's happening, and this kind of theme that I keep going back to of kind of lack of a story, we're not projecting out a coherent story into the world. We have quality of life issues in Manhattan and in New York.
Very much so.
And those stories are not being driven by local media. Those are being driven by kind of global forces and people competing for attention. And we can go
And
back-
for dollars.
and for money, right? People, the money, to kind of Jared's point, can shift to a lot of different places. And so because New York is not doing a great job in promoting the story of New York right now, we got the migrant issues, we got quality of life, we got crime. when you look at the overall stats, the crime
You're
rate,
hitting all my thoughts, but go
the
ahead.
crime issues, the crime is not that bad.
No.
But if you go out to different places in the world, what they're hearing is something very different than what we're
What's
experiencing,
actually
what's
happening.
And so that is another aspect of the problem right now, and why I thought that
Well, when
story was so important.
Yeah, but when I say geopolitical issues, I'm talking about things as you just described. It's the way it is broadcast.
perception, you're right.
It's perception. It's the way people receive things, good, bad, or indifferent. Right?
Yeah.
You could know something, twist the facts, and put it out there, and people are like, "Oh, crime in New York City." And I hear people say this to me all the time, and I think, well, I'm living in New York City for I don't even know how many hundreds of years. Where's their crime? Okay. Yeah, it exists. It
So
exists
we've
all
had
over
a
the
couple
world.
of very visible things happen, and those things
Well-
have gotten so amplified.
Correct.
Yep.
Correct. And that's the point. But we also have to take into consideration, aside from the war, conflicts around the world, et cetera, we have to take into consideration this is 2024. We have a major election year happening this year. In general, and I always like to ask this question in election years, is that going to affect? Has it been affecting? The purchase power in the luxury market, or just in general, because people are kind of taking a sit back, wait and see, like they would anyway. I can't buy right now because I don't know what's going to happen, and I always think and tell buyers when they give me that nonsense, why do you care what happens?
Well,
you
I
have
love
a
these
need
stories.
to buy.
I love these stories. In my feed yesterday, it's like a move to Portugal, right?
Move to Portugal.
Right.
My trainer
Not
just
a
said that
problem.
this
Right.
morning.
Portugal
like,
has
"You
been
sell real
very
estate
hot."
in
It
Portugal?"
has.
It
and,
has
and,
been.
And running up to the election, the story being promoted out of Portugal is move here, right?
Yeah.
You can get a nomad visa and you can work out of here
Yep.
as we approach. The competition is also global, right? With where the dollar's going to go.
Yeah, for sure.
What's going to happen in the election? How's that going to affect New York? I don't know yet. I don't know if
New
you
York
guys
is
are
still
seeing
going to be
anything.
New York. What happened after 2016? We went in about a 6-week depression and we emerged from it. So obviously,
Right,
We're
that's
still
what I'm-
depressed from that, just to be clear.
Yeah, we
just
are.
to be clear.
We
But
are,
I would say to you
But the
that
point is, but people will sit back and wait.
Correct.
Okay, and say, okay, and now we'll go through
well,
whatever. and
they'll
then
use
we'll
that
come
as
back
an
again.
excuse.
Exactly.
But I would say that my experience, just my own little nucleus of vertical of business, is that I have had one person state that to me, because people otherwise people are just not prepared to wait. They're not prepared to wait another quarter, another 2 quarters to make a decision that is a long-term play. It is like, I'm not doing anything for another 10 or 15 years, and I want my roots to be settled. And if I pay $50,000 more, if I pay $200,000 more, and it amortizes over time, I am okay with that. I want to be settled.
So what's also interesting to look at is the average holding period. So when you look at the end user for
That's
condos,
increased, though, I think, right?
well, yes and no. So for condos, the average holding period, let's call it 3.5 to 5 years, and it's 5 to 7 for co-ops. We're about half the national average, right? National average, it's 7 to 10. When you look
He's
at
got all these numbers right at your
Yeah.
faces. My goodness.
numbers,
You think
right?
he was dyslexic?
Look at this guy.
when you look though at the luxury market, right, that holding period is actually longer because the wealthy individuals don't buy and sell quite often. They buy and hold. It's a legacy piece. It's a storybook. So that creates a different amount of turnover. When you look at the general market though, what has happened is we're now 2 years into this interest rate hike. So that means we're 2 out of the 3.5 to 5. So we're nearing that halfway point. Those people are going to feel the pain. They're going to need to move. We're going to see this big, incredible pop of transaction volume that was bigger, in my opinion, than we saw in the early days in 2021. And my magic number is 5.5. Once the headline interest rate is 5.5%,
Right, I
you will
agree.
see a huge reshuffling and unlocking. As rates start ticking back down, people just need to see that first tick down. And that's what we saw in December, January, and February that caused there to
Absolutely.
be that
And
transaction
that happened
uptick.
at the end of October.
Exactly. And then it went away.
That's correct. And then it went away.
Right.
So let me ask you something. What is your prediction on when that 5.5% is going to kick in?
A lot later than I would have thought a
You would
year
hope
ago
for,
or
yeah.
6 months ago.
Yeah.
6 months ago, I would have told you that would have happened the end of this year. I think now, best case, you're 18, probably closer
18.
to 24 months away. from us getting there. But what we need to see is the start of there being a pattern to decrease, because if we see a more consistent trend down, one can make a more rational argument about, okay, let me buy now with this interest rate when there's less competition, and I can refi in 2 years. But when you're having rates sort of sit here, it changes the calculus a little bit, and it changes the calculus of a renter to choose to go less liquid and be able to have to take that lock-in of now losing that flexibility. So we just need to see that things are trending downwards for it to create a bit more confidence and movement.
I agree with you on the rate thing. However, buyers will still come back and push back and say, well, yes, I totally agree with that. And yes, if it gets to 5.5, whatever it gets to, I can refinance and I can feel better about it. But in the interim, Vince, at these current numbers, it affects my monthly payment and I can't do it. Right. Mm-hmm. That's the problem that I think most buyers out there, most purchasers are out there are very aware that when things change, they can refinance. I mean, I've refinanced mortgage, rates in my buying, cycles for years. But I think right now, because everything is so high, and if you want to talk about condominiums, the common charges or maintenance have increased, tenfold. And now you add the 7% or whatever the number is on an interest rate, and the first-time buyer or even the second-time buyer says, whoa, I can't really do this monthly. And that's kind of what I'm struggling with, as I talk to people that I talk to on a regular basis. I can't seem to get them over that fact that take that rate, because at some point you can redo. Sellers, talking to a seller yesterday in the building that I've been selling in for 18 years. Well, I have 4%, and if I sell, what am I going to get, Vince? 7%?
Where am I going?
Yes, but what was their
what am I going to tell them? Yeah. I can tell them you're making $500,000 in profit on the apartment, but
also,
hello.
what is the bank paying you for the money that's sitting in the bank
well,
today?
That's another thing. Yep.
Different than the 50 basis points that we were getting when it was 2.35%.
Correct. Well, right. So you know what? For you, the listening audience out there and the viewing audience, we are in a pickle. The luxury market is a little confusing, but yet it really isn't. If you peel back and if you listen to what these guys just said today, it really isn't. You just have to, as we all agree and said today, you can't keep buyers down for long. People need to buy, have to buy, want to buy for a whole host of reasons. And so we just do that. So think about it. Consider your options. Rental numbers have gone up. We didn't get a chance to talk about the rental numbers today, but the rental numbers have significantly increased. They've leveled a little bit, but not really. So when you're talking about $4,800 for an average one-bedroom rental in New York City, it's crazy, okay? It's crazy. So consider your options. And I'm sorry, we're out of time. Jared, Cale, Louise, thank you so much for being with us today. Really appreciate it. Great conversation. Always love to have you come back.
All right.
We'll be right back. And my closing thoughts for this week: the allure of buying real estate in New York City is a complex blend of aspirations, investments, and lifestyle choices. For many buyers, owning property in New York City represents a symbol of success and achievement, intertwined with the city's global reputation and cultural significance. The vibrant energy, diverse neighborhoods, and endless opportunities for work and play draw individuals from around the world to consider New York City real estate. However, the decision to invest in property in this dynamic market is not solely based on prestige. Practical considerations such as potential returns on investment, proximity to amenities, and market trends heavily influence buyers' decisions, and they always do. Despite the challenges of high prices and competitive markets, the demand for New York City real estate persists, fueled by a combination of ambition, pragmatism, and the enduring appeal of owning a piece of the Big Apple. Why not? And that's our broadcast for today. Thanks to my guests for being here on set with me. You can follow me on Facebook, on Threads, Instagram, LinkedIn, or TikTok at Vince Rocco, or my website, thinkvince.com. And always remember how wonderful life is while you are in this world. Thanks to Elton John and Bernie Taupin for those lyrics. And from all of us here at Talking New York Real Estate and the More Network, thank you all around the world for taking some time to spend with us today. I enjoy it. I love it. You guys are terrific. I will see you next time. Be kind to one another. Make it a great day. Goodbye, everybody.